Hello and welcome to the Big Money Questions. I'm Rickard Straus, Personal Finance Editor at This Is Money. Today we're going back to basics with how is money created. I say basics, but actually it seems often the case that the simplest questions are the most complicated, which is why we're lucky to have two experts in this with us to help break it down and explain it for us. So we've got Fran Boyt. She is Executive Director of Positive Money, which is precisely what you do, is look at how money is created and whether we're doing it in the right way. And we've got Felix Martin, who is a macroeconomist and a fund manager and author of Money, the Unauthorized Biography. So let's start right at the beginning. Fran, can I ask you first, how is money created?
Good question. Well, there was quite a landmark paper that came out by the Bank of England in 2014, which described how most of the money that we use is created by commercial banks when they make loans. So if you or I go into a bank and take out a loan, then money is created out of nothing right then, and so is a debt. And 97% of all the money we use is created in this way, and the remaining 3% is in the form of cash and coins created by the Bank of England and the Royal Mint. The paper goes on to talk about how basically we use these accounting entries, which are in computer systems, and they are essentially IOUs from the bank. So when we take out loans, banks create money, and when we repay them, the money disappears. And so we are kind of using these temporary IOUs from banks. I think it's really important because the paper also describes how this is different to how money creation has been taught in economics courses over the last few decades. So actually the kind of understanding around money creation has kind of disappeared, and I think this is, one of the reasons that we've seen we saw the financial crisis happen, and also politicians not able to kind of build a sustainable recovery. We actually polled MPs in the UK about how money is created, and only 1 in 10 knew that banks create money through lending, and so the understanding has really disappeared. Similarly, economists such as Joseph Stiglitz and Paul Krugman, Nobel winners, have also made comments to suggest they're not exactly sure how money is created. So we're trying to kind of bring it back into the mainstream.
It seems so strange, doesn't it, that it's something so fundamental, that the premise on which it's created is so fundamental to almost everything that we do, and there's that lack of understanding. I wonder, Felix, where you think that's come from, and if you sort of have an easier, simpler way of explaining how it comes about than that is truthful versus the one that we've been taught, in economics textbooks.
No, I mean, you're absolutely right. It's of course very odd when you find something which is so central to the way our economies work and the society works, and that we all use every single day. And yet, Fran is right that most people have a fundamentally not very useful understanding of what it actually is, how it came to be, and so on. I mean, I think it can be explained by the fact that you can look at money like a lot of social institutions from two perspectives. And when you look at it from the bottom up, which is how, of course, most people look at it. I mean, most people just think of the money they use every day and what they do with it and so on, and that's how they think of it. And when you think of it like that, of course, money appears to be a thing, just like any other thing. It's like a table or a car. And you look at your money in the bank and you think, well, I own that money. It's a thing. And then you take it out of the bank and you're given some notes, and notes, of course, are physical things. But the truth is, when you look at it a little bit more deeply, as most people often do, that all begins to fall to pieces a bit. You realize that, as Fran was saying, only a very, very small proportion of all the money in the economy is actually in the form of coins and notes. And most of it, we all know perfectly well, is in our bank accounts. Mm-hmm. And those bank accounts, well, I mean, they're just sort of numbers on the screen when you check your balances on your online banking. They don't have any physical existence at all. So this bottom-up view sort of runs into a contradiction. People think, well, it's a thing. I mean, it must be a thing like anything else I am. But on the other hand, it doesn't really have any physical existence. And this conundrum is explained if you take the sort of top-down view, the kind of Olympian view of what money and finance is, the view that the Bank of England has, let's say. Because when they look at all the money in the economy and the financial system, what they see is a huge system of credits and debits, recorded, as it were, in an enormous ledger. Now, it's not a paper ledger, right? It used to be paper ledgers. People would write down, you owe me so much and I owe Fran so much. It doesn't work like that anymore, of course. It's all digital. It's just stored on computers. And it's mainly stored by the large commercial banks, Lloyds and Barclays and HSBC and so on, the big high street banks. But that's what they see. They just see an enormous network of credit and debt. And when you make payments from your bank account to the bank account of your utility company or whatever it might be, they just see your credit balance going down and the utility company's credit balance going up. And that, to them, looking from the top down, is what money is. It's a system. It's not a thing at all. It's a system. It's a way of organizing the way the economy works. And that is in many ways a much more useful and truthful way of understanding what money is. And it leads to lots of important and different questions about whether we've got a good monetary system or a bad monetary system.
Yeah. And the way you describe it, it sounds quite frightening. The idea that any wealth that I have is purely because my bank has written on this ledger that it exists, and that it's banks that decide how much we have in the economy and decides whether we should have more or less. Is it as frightening as all of that sounds?
Well, I think that positive money would definitely say that the current system isn't working and isn't working for most people. And that's because we have a system where high street banks create almost all of the money we use, and over the last 40 years they've basically had kind of freedom to create as much money as they want for wherever makes them the most profit, and they have lent mostly to property and financial markets, which has skewed our economy towards house bubbles and the financial sector, whilst a lot of us have ended up under a mountain of debt. So we don't think it's being done in a very fair way, and if we're going to consider other ways of creating money to make it fairer, we have to kind of ask ourselves, what is in the best public interest and what is going to be most useful for the kind of society we want to create. So we campaigned for a fair, democratic and sustainable money system. There is another way of creating money which has been done since the financial crisis by central banks called quantitative easing. I don't know if we want to go there, talk about that just yet, but basically banks haven't been creating enough money, so the central banks have stepped in and they've created, in the UK, the Bank of England has created £375 billion, and all of that has been used to essentially flood financial markets, which has resulted in stock prices going up, essentially the rich getting richer, but not doing much for ordinary people. So I think the figure is the top 5% of people became £130,000 better off because of quantitative easing. And actually the Bank of England released a paper admitting that it had increased inequality. So it's not a very fair system. And as I said, politicians don't really understand the way money's created. So we don't have a very democratic system because politicians aren't scrutinising it. And we've actually talked to politicians who've said they feel like it's outside their remit. The Bank of England's independent, so they don't want to get involved. But actually, if you look at the consequences of this system of banks lending to property and financial markets, we had a huge financial crisis and QE has resulted in increased inequality, then there are very serious social and economic outcomes of this system. So we do need to scrutinise it in a democratic way. And finally, just to make the point about it not being sustainable, we kind of rely on ourselves going into more debt through bank lending in order to keep the economy going. But since it was these really high levels of private debt that led to the financial crisis, then how can that be the solution? Economist called Adair Turner calls it a hair of the dog strategy. So we really need to think about how we can redesign a system which doesn't rely on ever increasing levels of debt, which will inevitably end in a crisis.
sounds like quite an overhaul that we're going to have to consider, and it's difficult to do it from a position of that level of lack of understanding among people and among politicians. But I think that when we think about commercial banks, I mean, obviously they have some issues and people are angry about the banking crisis, but generally, you know, they give people money for their mortgages, loans if they want a car. We sort of don't see them as working against our interests in that way. I wonder, Felix, how you think that's come about, and whether sort of what analysis of them is fair.
No, that's right. Although, I mean, I think some people certainly see them as working against their interests. But I think people generally have the right idea when they don't see that as working against their interests. I haven't come across many people who are advocating completely abandoning the current monetary and financial system as it stands. You know, we should move to a planned economy which is not organized by markets and doesn't use any money. That was what was tried in the Soviet Union immediately after the revolution, but they discovered that even in that period, they discovered it didn't work and they had to reintroduce banks and money. People aren't talking about that, and very sensible people with sensible suggestions for reform like Fran and her group are not talking about exactly that. What they're talking about is the fact that if you understand that money is created by banks, the question is then, what rules do you set to incentivize banks to create money in a certain kind of way and a certain quantity? Mm-hmm. And that's the canonical problem of regulating a banking system, regulating money in a modern capitalist economy like ours. So in one sense, it's much easier than changing the way things are done in, let's say, the industry that makes tables, to go back to what we were talking about earlier on. You know, that's quite difficult. You might have to sort of get rid of your old machinery, bring in new machinery, and so on and so forth. You don't have to do any of that, right, when we're talking about money. It's all about the rules and how these banks are incentivized to make money. And what Fran was saying, I mean, she'll tell me if I'm putting words into her mouth, is that over the last 30 years, we've gone down a route of trying to rely more and more on the market mechanism and simple market incentives with as few regulations as possible. We're trying to allow that to guide the way that banks make money. What, for example, they lend for in order to create money. And Fran was, as she was saying, what it's meant is that we have in the UK, for example, ended up with a banking system where 80% of the loans in the banking system are essentially mortgages for property of one sort or another. So very heavily skewed towards property and, you know, sort of skewed against, if you like, lending for business. And the question is whether we think that's a good outcome, whether we think we can design a different set of rules, all right, which will not, they're not going to prescribe everything which banks do. That's moving towards a sort of planned economy. That's not what people want. No one I know wants exactly that. But it might be that you could have a better set of rules which incentivize all these private banks, people just thinking what they should do on their own, and that might incentivize a more sensible rate of money creation, the lending against which money is created, and so on and so forth.
What kind of rules then, I wonder?
Well, positive money focuses on the money creation. We also think, as Felix has talked about, we need kind of a new set of institutions that are interested in lending to the real economy, and by real I mean non-financial, so not the finance, insurance and real estate as we see most lending going into those sectors. Mm-hmm. The real economy is where most of us live and work, and it's about creating jobs and businesses for people across the country. And what we talk about in the short term is thinking about how we need to stimulate the real economy. And so there's a lot of discussion, especially post-Brexit, that we need an economic stimulus. One of the issues is that the Bank of England is pointing to similar policies that we've seen, so lowering interest rates or another round of quantitative easing. Mm-hmm. The issue with these policies is they're really about getting people to take on more debt, as I've talked about, so putting households further and further into debt, and that's a danger for financial stability. I think the Office of Budget Responsibility says that we're going to be at pre-crisis levels of private debt by 2019. So we're in quite a vulnerable position, and what we actually need is new money to be getting into the real economy, directly into people's pockets, to create jobs, boost employment, and boost businesses. And at the moment, we don't really have institutions that are getting money to the real economy. So we're saying we should be doing QE differently. We call it quantitative easing for the people, or public money creation, and that new money should be created by the central bank, but either put into the real economy through government spending or through direct citizens' dividend, so direct distribution of cash to citizens. And these ideas are actually gaining quite a lot of traction among economists all over the world, and among central banks even. There's been a lot of discussion about whether these ideas are going to be put into practice in Japan. I don't think they are, but the idea of distributing cash to citizens is called helicopter money, and it's gaining quite a lot of interest because of the situation we're in, where essentially central banks are out of monetary policy tools that are working to stimulate the economy.
It sounds quite radical, I think, to lots of people. Especially the image of helicopter money really sounds like last ditch. You know, we've tried interest rates, people aren't spending more, and we've tried QE, and you know, we don't know that necessarily worked last time round. Why on earth are we going to do it this time as well? But helicopter money, is that really, do you think, the answer, Felix?
Well, I wouldn't rule it out, but to me there's a more obvious place to start when we're talking about the recovery. So moving slightly away from, Fran was tying together trying to stimulate a recovery better than the one we've had so far from the crisis, and reform of the financial system. And you know, what you were saying about reform of the financial system is very important, but I wouldn't tie it together at this point with trying to stimulate a recovery. I think there's a much simpler and more traditional way of doing that. We're living in an era where the government can borrow at historically unprecedentedly low interest rates. What I mean is the interest rate on gilts. The government sells gilts. That's how it borrows. It doesn't borrow from banks. It borrows from pension funds and insurance companies and the general public by selling its bonds. And the interest rate that it has to pay on those bonds is now incredibly low. It's lower than it's ever been in the entire history of the government debt. And that means that for a project to justify the government borrowing in order to invest in it, you know, high speed 2 or whatever it might be, just maybe rebuilding roads, or it could be anything, it doesn't have to be all that profitable over the long term. It only has to beat an incredibly low bogey. So I think the obvious initial question is, why on earth wouldn't you be taking advantage of these incredibly low interest rates in order to borrow and spend?
I find it so funny that this idea has sort of become, just in the last couple of weeks, more normalised, that until now it's been austerity, balancing the books, fixing the roof, all that stuff. Why on earth would you spend more money when we already have all of this debt on our books? And now that's sort of being quietly shifted out along with Osborne, and maybe we could sort of move in that direction. Seems like in this era of uncertainty, it's all up for grabs again. It's quite fun, and it seems like a perfect time to go back to the drawing board and ask the questions about where it all came from in the first place. Thank you so much for joining me. Thank you for joining us. Fran Boyt and Felix Martin, thanks so much.
Thank you.